So what's up with all this talk about mortgage interest rates rising, but last week rates dropped almost 0.75%? What is going on? I thought we were going to the moon in regards to the rates. What's up, everybody? This is Luis. Hope you're all having a wonderful day. In today's video, I want to review what happened in the market last week in order to make sense of it all. I mean, we're hearing that the rates are going up, yet they dropped last week. So let's dig into it a little bit more. And while there are dozens of factors that affect the mortgage interest rates, I'm going to focus on one, and that's inflation, because inflation is by far the worst enemy of mortgage interest rates. Before we get into it, make sure you click on the subscribe notification button below so that you're notified every time I create new content. I really enjoy making these videos and I don't want you to miss them. Let's jump right into it because I got a good one today. As I just mentioned, inflation is by far the worst enemy of mortgage interest rates. And that's because it eats up into investor earnings. What do I mean by that? Let me explain. You buy a bond for $100 and that said bond will pay you a 2.5% interest, which is great because your bank is probably paying you 0.0000002%, right? That bond is also the most secure risk-free investment out in the market. However, with inflation at 8%, that investment is a loss because the return of 2.5% isn't even keeping up with inflation. At $100, that's no big deal. Now imagine a $100 million investment. Well, the loss is huge. So that investor will probably sell off that bond before inflation gets worse and the losses are greater. And just like stocks, as the bonds begin to sell off, the value drops. And as an investor, you don't want to be the last one holding those bonds. Super important side note. If the value or price of said bond drops, the mortgage interest rates rise. If the value or price of that same bond increases, mortgage rates drop. So bonds and mortgage interest rates have an inverse relationship. So there's a whole lot more on this, but that's a video for another day. So now that you understand how inflation affects mortgage interest rates, let's briefly take a look at the latest inflation report. It's called the Consumer Price Index Report, or the CPI report. As you can see, there's a lot of details on this report, but let's just focus on the energy section, which is causing the most impact. And as you can see, it's up almost 50% in the last 12 months. So why is this important? Well, gas prices, we know, have increased. The fuel that we need to transport food to grocery stores, for example, has increased, and is why prices at the grocery stores are up. And this concept pretty much applies to everything that requires energy for production and or that needs to be transported. So why is all of this information important? Well, let's do a quick recap. At the beginning of the video, I said rates are down, which means bonds are up. And for bonds to be up, it would mean that inflation is peaking. The answer is yes, at least according to the 3 reports that were published at the end of last week. Those reports are indicating an economic slowdown, which will slow inflation down. Now, let's quickly review these 3 reports. Let's start with the manufacturing index. This index measures manufacturing production levels across the United States. Last week, this manufacturing index fell to 53 for June of 2022 from 56 in May of 2022, pointing to the slowest growth in factory activity since June of 2020. This is a strong indicator that factories are slowing down production because the demand from the consumer is down. And if the consumer is not buying the goods, then there is no need for production. The second report is the Personal Consumption Index. This report measures the prices paid for goods and services. This report also came in below expectations, indicating that consumers are spending less on the non-essential items and more on the essentials like gas, energy, and food. So that new 4K plus 10K Hyper HD TV will have to go on the back burner. The third report that was released at the end of last week was the initial jobless claims. This report measures the number of persons claiming unemployment benefits. that came in higher than expected. And this indicates a tightening labor market, aka layoffs. And we have seen and read about this all over the news. So to bring it all together, mortgage rates are trending lower because inflation concerns are showing signs of peaking. And that's because when consumers are unable to spend on the non-essential items, then this tends to cause an economic slowdown and inflation concerns tend to go away. This again is amazing for bonds and it results in lower mortgage interest rates. I know this video is just scratching the surface on all of this, but I really hope this gave you a little bit more insight on what causes the mortgage rates to fluctuate so much. And with that, that is all I have on this video. I know this was a tough one to follow, but I hope this information was useful. And if it was, hit the subscribe notification button. Your feedback is super important to me, so let me know what you think in the comments section below. Thank you for listening. Thank you for watching, and I will talk to all of you soon in the next video.